Welcome to another episode of Keeping It Realty with Marc and Brian. So before we jump into the show, once again, thank you to East Brother Beer Company for being the show's sponsor. They have a great taco cook-off event coming up for Cinco de Mayo. So that's going to be exciting. It's on a Sunday.
Tacos and beer.
Tacos and beer. Can't go wrong with that. So Sunday, May 5th from 1 to 8 p.m., I'll be there, and I'll be showing my support for East Brother Beer. And today we're drinking their red lager.
I've had this before. I like this one.
Yeah, I think we've kind of ran through older beers now.
We have.
And so now it's just going to be really just
we
enjoying
like
it.
this one.
Yeah.
After the second time.
Okay, so we're going to jump right into the show. The very first topic is Zillow is suing Compass Real Estate. Brian, what's your initial take on this? Why is Zillow suing Compass? Can Compass get out of this? I mean, is this even a lawsuit that has any validity to it?
Well, just kind of looking at it from the initial overview of what it talked about, to me it looks like Zillow is really just kind of flexing its muscles. Zillow is more of a technology company. Compass is a real estate company that's kind of priding itself as a technology company for real estate agents to brand tech, and I guess part of what the article discusses is that Compass wooed over employees of Zillow, and they caught these employees emailing specific proprietary software or tech from Zillow to themselves just before they left. And so again, I'm not a legal expert when it comes to intellectual property, but I'm not exactly sure where all of this lawsuit is going to go, other than Zillow is kind of putting its foot down and trying to, flex its legal muscles just so it's got more money.
For sure, they're trying to get ahead of it, because if they can try to squash it now before anything starts, because like you said, Compass is touting themselves as a tech company. However, we all know they're not a tech company. They're literally a real estate brokerage.
Right. They're a real estate franchise.
Yeah, they might offer technology services to their agents, but that doesn't make you a tech company, right?
Correct. Yeah.
It's just like any other business that offers, software to their employees. So anyway, so you have the stealing of this information, and I see where Zillow is coming from, because if Compass really wants to focus and maybe even pivot their business model and their strategy and really focus on attracting a lot of new leads coming in by building something using Zillow's model. A perfect example of one of Zillow's biggest competitors that is also a real estate brokerage is Redfin. So you have Redfin that has this amazing system that there's a lot of home buyers out there that will either use Zillow or Redfin. And so people will look at Redfin, even though they don't use Redfin as a brokerage, but they still use their entire home search system in order to look to see what's on the market, or even sellers looking to see what their property is worth. So it's very comparable to what Zillow has. So Redfin and Zillow compete.
In fact, a lot of this technology that Zillow is using really is the similar technology that Realtor.com or Trulia uses, where they literally take data from the various MLSs and then generate leads from that and resell that back to the real estate agent. So there's a bit of
it's probably 98% MLS data. So
correct,
that's the irony about all this, is that the MLSs that have real estate agents and appraisers subscribe and enter the data into the MLS, then
is uploaded
for the most part will give Zillow and all these websites free syndication, and then these websites sell that data and the leads right back to the agents.
Right. And so again, that goes back to the old days when real estate agents had this thing called the MLS book or the multiple listing book. And the big value add that a real estate agent had was they could tell you what was for sale. And now that's not really what we do so much as we guide the buyer through the legal steps and process and financing. But buyers can go out there and find the data themselves now for property that's for sale. And so it's just kind of an irony that Zillow is suing Encompass for doing basically what they do.
What they do to real estate agents.
Yeah.
Yeah. So I don't see this really going anywhere. I'm sure there's going to be some kind of settlement. There's maybe not even a settlement. Everyone might just drop it, but I can totally see why Zillow is jumping ahead of this to prevent Compass from becoming a company like Redfin using Zillow's actual intellectual property.
The funny thing though too is most times when companies will do this, it comes down to like who's got more disposable capital in a lawsuit. Because a lot of times in lawsuits, nobody really wins except for the attorneys. And I think they've kind of taken they're trying to take on a pretty well-funded company, and that's Compass. Because if I recall correctly, somebody who had talked to me about Compass, which is a fellow real estate agent, had mentioned that they're backed by some Saudi Arabian
correct
prince or something. And so that's some deep pockets there when you've got oil money, and you want to get into the real estate business. So you're going out and you're essentially raising capital on Wall Street to go out and buy real estate companies and consolidate all of this under a big tech umbrella.
Yeah, I wonder what percentage of the Compass agents will stop using Zillow and possibly go to a different platform offered by Compass. It'd be interesting to see.
Right. That's a big question, because a lot of times agents are always going after the new bright and shiny toy, or what's the grass is greener on the other side. So the technology really depends on how well the agents use it. And so those same agents that are within Compass now probably subscribe to Zillow, at least some of them do, to generate advertising.
Yeah. So the second topic we're going to get into is the San Francisco Housing Authority, their little turmoil problem going on right now, and HUD, stepping in. So basically, to give you a little bit of history, many different cities, like large cities like San Francisco, Oakland, Berkeley, Richmond, they have their own housing authorities. Most people associate housing authorities with Section 8 housing assistance. Now, what many people don't realize is that Section 8 and various different programs under the housing authority, those funds, that money comes from the from HUD, the federal government. And so one of the requirements is that if you are a city and you have a housing agency and you're getting federal money, you have to comply with a lot of their regulations, with accounting, how things are processed, because it's the federal government handing you money to then hand out to other people. So there are rules, requirements in accounting and different practices. And what has happened recently is the cities treat housing authority funds as if it's free money from the government. And we have been seeing some mismanagement. Richmond, California made the news just a couple years ago when they went through an audit and found out $4 million were being siphoned from housing authority to pay off bills in their normal operating expenses. That's horrible, because this is money that's supposed to go to help low-income families, and instead the city of Richmond is using it to pay their own bills. So San Francisco went through a very similar audit. They found that there were some accounting practices they shouldn't have done. They're short on cash and they're having some issues. And so basically HUD stepped in and said, you need to raise your minimum tenant payment, which is $25 a month, to $50 a month. And San Francisco basically came back and said no.
Right. And let's now put this in perspective. So if you're a tenant on Section 8 or subsidized housing, and your rent is $1,500, and based upon the income that you generate and your expenses, the most that you could afford is $25 a month. That means that Section 8 or housing will pay all of that money, the $1,475, and all you've got to come up with is the $25. Now, that $1,475 is what we're talking about, that's coming from the federal government. And again, when we first discussed this story, I was just like thinking to myself, wow, the audacity of San Francisco. And it's got this nickname of the People's Republic of San Francisco, where it almost sounds very communist. But the whole position is that they have, to me, just had audacity written all over it. Clearly they were kind of caught with their hands in the cookie jar. Regardless of what they have to say, they were kind of mismanaging funds, and it's government funds, and they're kind of allocating it, as Marc said, towards other city expenses that really aren't supposed to go to housing. And so rather than clean up their act, or rather than just take the advice of housing or the federal government, which was, well, you can raise the minimum amount that each of the tenants have to bring in from $25 of their rent to $50.
Well, that would only solve part of the problem.
Right. But they basically didn't even want to, that wasn't even on the table for them is what it came down to. They were just willing to go basically blow them off.
In San Francisco, being the typical San Francisco, I guess, politicians and government, which is what so many people criticize them about. But Mayor London Breed came in and said, no, we're not going to make these changes to the housing authority. And so HUD basically said, okay, you have an ultimatum. You have until this certain date to give us a proposal on what you plan to do to fix this. And one of the solutions is you as a city take over the housing authority and figure it out on your own. And that's basically the plan that the city of San Francisco wants to go with. The problem is, where are they going to get the funding for this?
Well, where are they going to
How are they going to?
They already set the precedence and the track record for kind of mismanaging funds.
Correct. And then London Breed came out and said that if they move forward with this and the city takes over the housing agency, they may not be employing the current housing authority employees.
Right.
And so they let those people go. Who's going to take over the housing authority and actually operate it efficiently? And
Especially
the answer is it's going to be
a big learning curve on something where the existing people there don't completely understand all the ins and outs of the bureaucracy.
Yeah, and so this is going to be a big problem, a big obstacle for San Francisco, because if they can't figure this out correctly, well, there's going to be a lot of families that are really going to be impacted by this. And these are families that have voted these politicians in, and these politicians do not want to give up control to the federal government, because we all know San Francisco is butting heads right now with the White House administration. And I feel like it's just another reason for them to go against the White House. And at the end of the day, and I understand people's attitude toward the White House and not happy with it, but you're really going to hurt a lot of low-income families if you can't get this figured out. So we're going to get into our next topic here, and we're going to be talking about young people and the stock market. And there's an article that came out, basically a study showing that only 37% of people between the ages of 18 and 34 invested in the stock market, compared to 61% for those over the age of 35. And let's see, this was pre-2008. 52% under 35 were investing. 32% of those 18 to 34. Okay, so this was pre-2008. So basically, there were more people investing in the stock market, millennials, compared to what millennials are investing today. And I think one of the biggest reasons is that you don't have stability in the job market. And there's been plenty of articles that have been coming out in the last year about what millennials and even the next generation have to go through and are going to go through, because there's just not enough jobs to provide stability. So you have a lot of people that are working 1-2 part-time jobs, plus doing Uber, Lyft on the side. And they're doing a lot of these part-time jobs, gigs. It's the gig economy is really what they're terming it. Mm-hmm. And that does not provide stability. So if you don't have stability, the last thing you're going to do is take whatever money you have in the bank and reinvest it into anything. And that could be real estate, stocks, anything.
Well, a big part of it too is just the whole big social mores have changed. In fact, a big part of the question we were trying to answer is, do we need to encourage millennials to invest more in the stock market? And again, I don't really invest much in the stock market. I have like a mutual fund for my SEP IRA and things of that nature, but I don't actively participate. So I can't really even speak to the fact about should millennials invest more in the stock market, because I'm not a big firm believer in it myself. But the other big part of it, as Marc was saying, is that it's a gig economy. The people don't stay at their job for 20 years or 30 years anymore as they did in the past. And so they're working multiple jobs and they don't have that additional disposable income. You see apps out there all the time where it's supposedly making it easier for people to invest a smaller amount into the stock market. However, the statistic does point out not too many people invest in the stock market. And I guess, I have to speak to that. I don't have a whole lot of confidence myself in the stock market and its volatility.
Well, the reason why the stock market is so important is because the stock market is very easy to get into. I mean, you could literally buy penny stocks and you're in, right?
You could, yeah.
And then, I mean, if you wanted to buy share of Facebook, I mean, I don't know where that's at exactly right now, but
well, I mean, a couple of
I
the brokers that work with us here in the office, they're really, really big into the stock market. Now, you know, a lot of times I'll look over their shoulder as they're trading. I have a couple of day traders here in the office that work real estate as their primary gig, and they like to play the stock market doing day trades. But again, as I look at it, I'm just thinking, you know, how volatile it all is, and you really it has to be a full-time job to kind of watch your stock portfolio. Otherwise, things can change so rapidly. And again, that kind of speaks to what you're describing, where the majority of people within that age bracket that the study focuses in on are working 2-3 jobs. And so even if they do have income, they don't have the time to really monitor stocks the way that you need to do today if you're going to make any money in it.
And one thing that you really have to, when you're looking at the economy, you're looking at news, and you hear people talking about the great low unemployment rate. I mean, we're at a record low unemployment, yet you have to understand that figure a little bit better. Just because we're at a super low unemployment does not mean that the economy is great. Yes, it's a good indicator, it's a good sign, but it's not the be all end all. And so look what happened when you saw the short-term rates rise up just a little bit. Corporations got scared. There was a lot of turmoil that happened. Look at what happened when the government shutdown occurred. We had the longest government shutdown that happened from the end of 2018 rolling into 2019.
Right.
It really showed that a lot of people, you had people with decent jobs that are making good money that all of a sudden could not pay bills and were applying for food stamps. And there's been plenty of studies in the last year that showed so many Americans, about 55 or 60% of Americans, do not have an extra $300 to spare, including credit card or access to credit cards. So with that said, even though unemployment is very low, you have to look at how those numbers are calculated. And the reason why is because you have a lot of jobs that are created, but there are a lot of part-time jobs that are created.
Right.
And this is one of the biggest reasons why.
And if you work
you don't
for
have
Uber,
stability, you're not gonna invest.
it's not a bad thing. We have clients who have bought homes and their primary source of income is Uber. So it's not a bad gig. It's just, again, a lot of these people are going to be working multiple jobs, don't have the time to focus, and let alone have the disposable income.
Yeah, most Uber drivers do it as a part-time gig on the side, not full-time. But yeah, I know some people who do it full-time and they make great money.
They make great money and can buy a house.
Okay, so next one is robo agents. Basically, technology, AI mixing in with the real estate industry. And this is something that keeps coming up every few months. Technology, there's some new technology coming up in real estate. How is that going to affect agents, the agent's role in the business? And I'm excited. I love to embrace technology. I think it makes my job way easier. It makes communicating with people much easier. It makes getting leads and getting new business way easier. And
yeah, no, absolutely. The way that we generate leads today and the amount of the amount of information at my fingertips that I can find out about a person just from their cell phone or their email to determine if they're a valid buyer or suspect or prospect is just light years from when I started back in 1991.
And we're at a record right now of the most amount of capital being invested by tech companies and venture capital firms into the real estate sector and creating so many products. And of course, we're starting to see AI bots.
Right.
And the next evolution after AI bots are going to be actual robots that can assist us. But we may not be having like actual physical robots. These are going to be robots or artificial intelligence within our computers, within our iPads. I mean, we have, Alexa and Siri already, but as those develop and get even more, where do you see real estate going?
Well, I really see it being able to implement the human more so than it becoming its own autonomous, standalone artificial intelligence being able to carry on a transaction from start to finish. If the technology does continue to advance the way that it's going, then for producers, then their ability to be able to use or deploy AI like a transaction coordinator could, has limitless different boundaries.
And speaking of transaction coordinator, that's going to be one subsector of the real estate industry that we all need to really watch, because there are AI bots right now that will scan and read full contracts, legal contracts, and will be able to identify signatures, initials, items missing from the contract, and be able to notify all the different parties. In fact, there was a law firm, and I can't think of their name right now, but there was a law firm about 2 years ago that they announced they're using new AI bot technology where they cut out 200,000 legal hours of attorneys sitting down reading through contracts. And they did that through AI bots.
Well, I mean, that's just another offshoot of the technology like the NSA uses, where they can hone in on keywords you might be saying over your cell phone, like bomb, right? It's the same root technology.
You just got us on the NSA list.
Right. It's the same root technology that attorney firms use to basically run search words on your email so you can find specific words when you're litigating against somebody.
And the one thing that I always found,
now that it's just got, some type of a logic behind it.
The one thing I always found a bit annoying about the real estate industry is so many people against embracing technology. I feel like so many people get stuck in there.
Kind of gone. I remember those
Not
guys.
really. If you go out there and talk to a lot of people,
you can still find some people who write contracts on paper. Yeah.
Yeah, but it's not just writing contracts on paper. There's a lot of people that simply don't want to embrace any new technology simply because they feel as if their business is going to get cut out, instead of embracing it and seeing how they can use that technology to increase their own business. And so it's a completely different mentality.
Sure.
So one fun question that we have here is, if we end up actually having robot assistants that sit in our office and doing most of the legal paperwork, and because we're Star Wars fans, if that robot could be a droid from the Star Wars universe, which droid would it be for you?
From the Star Wars universe, it'd have to be C-3PO. At least he's got a humanoid body and can actually do some stuff like sign contracts.
And he's fluent in over 1 million languages.
Exactly. So I could transact business in that many languages, and if it's R2-D2,
I don't think we have 1 million languages on Earth, though.
We don't.
You would have to start selling real estate on Mars to find other different clients.
Correct. But yeah, I mean, it's definitely C-3PO, because he's got the full-on hands and can walk around and talk. Just got to bring the annoyance level down. That's all.
For me, it'd be Chopper. Chopper is from the Star Wars Rebels animated series.
Oh, yeah.
And
my daughter watches that.
Yeah, for me, it's got to be Chopper. He would just be hilarious. He'd be the worst employee in the world, the worst robot to actually have as an assistant.
I'm sure we would have DRE in our office all the time.
He would mess up everything, literally, but it would be a fun journey every single day. So that would be my answer. Okay, let's get into our property analysis here. And Brian, what property do we have?
So today we're going to analyze an 8-unit building in Fairfield. Very specifically, I'm kind of looking at this particular property for a client of mine who's currently in contract to sell his 4-unit building, and he's going to yield somewhere to the tune of $753,000 to $780,000 of cash that he can roll into other properties. So this particular 8-unit building in Fairfield is listed with an agent that I've done business with in the past. Sold another large apartment complex, 28-unit in Sacramento with.
What's the general area of where this property is located?
Well, it's actually kind of close to where you grew up, I think, because you grew up in Fairfield, right?
I grew up in Fairfield by Paradise Valley.
Okay, so this is actually close to that area. Now the 8-unit building is comprised of 8 2-bedroom, 1-bath units, and they're all 1-story garden-style apartments, and it's got an open courtyard area, so you don't have a bunch of stairs to go walk up and down, and it's an open ranch style, actually, is what I was looking for. The property's asking $1,440,000. Now, at $1,440,000 with its current income, it sits at about a 5.16 cap. Now, in previous episodes, you've probably heard me talk about how the market's beginning to slow down, and you're seeing deals go back up to a 6 cap. Now, again, for those of you who don't know, cap rate is the return that you would make on your money if you bought the property all cash. You took into consideration its current income minus all of its expenses from taxes, insurance, to vacancy, to management fee, to utilities, except a mortgage payment. And it's a common denominator or initial denominator that investors will look at to determine the amount of return they need to make to outweigh the risk. Now, at a 6 cap, this property would be worth closer to about $1,243,000. So then you got to ask yourself, well, why are we talking about this deal if it's asking $1,440,000? Well, a couple of things. At $1,440,000, it still comes in at a decent cap of about 5. And in prior episodes, and I always tell all clients, is that if you can start out between a 5 or a 6, and you're in an area where you can kind of mark the return on your income just through regular rental increases. In this case, Fairfield doesn't have rent control, so you could go up to 10%. You can see that the cap rate would rise from a 5 to a 6 to a 6.25 the second year. I'm sorry, from a 5 to a 6.03 to a 6.88 to a 7.82 by the 4th year. Now, what all these numbers mean is that not only will the cash flow increase, but the value of the property will increase as well. A couple of other components that I always like to look at is I like to reach out to see if I know the agent, if we've done prior deals, and what the seller's motivations are. This property actually has 3 existing offers on it right now. Now they're not close to the asking price, from what I understand. And the other thing is that the owner who bought the property, he bought it all cash, so he's not in a position where he has to sell. In fact, a couple of things I kind of gleaned from discussing this with the listing agent is that the owner will only sell if he can find a viable exchange or another property to buy. And what this particular owner is looking to get into is mini storage. Now, I really like mini storage. It's a great investment to get into. Very, very, like they make TV shows about it, right? Like, storage wars and things like that. And from a real estate investment standpoint, it's very stable. It's got a good return, and you don't have to deal with evicting tenants or rent control or things like that.
Well, the eviction of a storage rental unit is way easier,
it's way easy,
quicker.
And then you could even sell, like blind sale of what might be in those mini storages, and people actually bid against them. So again, another animal, but we're not analyzing mini storage. What that has to do with this particular angle is that my client, as I mentioned earlier, he's in contract right now to sell his 4-unit building, and he's going to do a 1031 exchange, and he's looking to place the money in different other investments. So from a debt service coverage standpoint, and what that means is how much of a loan a lender would loan on this property, they would go up to 70% loan to value. From the information that I gleaned from the agent, even with the other offers in place, even though the property is asking $1,440,000, there's a very good likelihood we'll be able to get an acceptable offer at $1,420,000. And at $1,420,000, it's going to come right in at a 70% loan to value, meaning the client has to put only 30% down, which means out of pocket they're going to come out roughly $453,000 to $475,000 out of the $753,000 that they're going to be working with, which allows that client to not only potentially buy this property, but buy additional properties and perhaps another single family home that they could eventually move back into. So there's a whole nother array of different angles that a client could look at in making a return on this. Not to mention, if they're in a position to buy this for $1,420,000, now instead of coming in at a 5.16 cap, they're coming in a little bit higher, 5.25 cap, which means that they're still going to be buying it a little bit. They could be getting a better deal, except that it fits the criteria that a client is looking for the amount of money they've got to work with. We're not going to get the property for $1,243,000 just because of the amount of competition. And even coming in just 20 grand below their asking, there's a possibility that we would be able to get an acceptable offer. The client would be able to get the loan. It would come in at a 1.2% debt service. And again, for those of you who don't understand what that means, when a lender decides that they're going to loan money on a property, they want to make sure that the net operating income, again, that's the income that you have left over after taking income minus all expenses, but before paying the mortgage, that net operating income has to be 120% greater than the proposed debt. So if you've got a $10,000 principal and interest monthly payment, you need to have an NOI of at least $12,000. So a lender wants to see that you're making 20% at least above what you're going to be paying them in debt monthly, principal and interest. So when you look at it from that angle, the client comes in with a pretty decent cash flow, still has additional capital they can deploy on other properties, and take that 4-unit building that they relinquished or sold off in a 1031 exchange and potentially trade that into an 8-plex, another 4-plex, and maybe a duplex or house. So they've multiplied their units while still getting into a property that fits into their budget, has a potential for immediate cash flow, which secures the asset, and just through normal rental increases, nothing that's like swinging for the fences, they can increase their cap to 7.82 by the 4th year. And so what that means from a capital gain standpoint is this property that they buy for $1,420,000 within 4 years, if you're using a 6% cap rate, when they go to sell it, even though they might be at a 7.82 cap rate, that would mean a $431,000 capital gain if they decide to sell the property, because the property would be worth somewhere within the ballpark of $1,851,000. Now, lo and behold, if the market turns the other way 4 years from now, meaning it's back to a seller's market, and people are buying at a lower capitalization rate, meaning they are willing to make a lower return because they perceive a lower risk in the market, or it's a seller's market, then selling this property at a 5 cap would bring the property as high as $2,222,000. So roughly a $650,000 capital gain in 4 years that, again, would enable this client to be able to sell the 8-plex and then trade it into more and more properties. Again, it's the same type of methodology that I've used for myself and for my clients throughout the last 29 years that allows them to go from a 4 to an 8 to a 16 to a 32 and just continue to exponentially grow their unit holdings, cash flow, and tax write-offs. So again, this is some of the angles that I look for when I'm analyzing a property.
Now I've had a few clients ask me about Fairfield, Vacaville, that little pocket area. And they've asked me, well, what do you think about rental prices there? Do people really want to rent housing there? And what many people don't realize is that Fairfield has grown so large. I mean,
yes.
I moved there my parents moved there when I was 4 in 1989, and it was very small. There was literally nothing in Fairfield, and now it's a pretty large city, and it's a great middle point for a lot of people, a lot of couples that will maybe one person works in Sacramento area and the other person works in the Oakland area.
Right.
And it's a great middle point.
Yeah, and you know that it's the crime rate is low. It's not like the Bay Area where the rents are really, really high. Again,
and you know what? The biggest factor, or one of the biggest things that keeps the rental prices pretty strong in Fairfield is Travis Air Force Base.
Right, the military base. I was just going to say. Yeah.
You have the military base here. That's one of the largest on the West Coast, and they provide a lot of housing vouchers for military men and women, and that goes to feed the rental market.
Yeah, feeds the rental market, keeps a good stable asset for landlords, and just keeps the economy rolling.
So the question is the building a buy or a pass?
I think it's a buy. In fact, I'm going to write an offer for it from my client and see if I can't use my past history with the listing agent as well as this analysis on what the owner wants to do. Again, the owner needs to buy a mini storage. So I told the listing agent I was going to call up some of my old mini storage deals and see if they might want to sell. And you know, this owner is willing to go all the way down to Arizona. And I've transacted business in Arizona before, mini storage specifically, because that's huge down there. So we'll see what happens.
Yeah, perfect. So thank you for watching another episode of Keeping It Realty. Thank you to East Brother Beer Company, and hope you guys have a great week. And you know, one thing that I'm kind of working on right now is putting together actual case studies of properties and buildings and complexes that we've worked on, because now we've been in business almost a year and a half as BG Asset Management, and we've helped out quite a bit of people that have brought us some problem properties.
Yes.
And basically we take it over and the owners let us do what we do best, and we go through, revamp it, get the rents up high, cut down expenses, fix problems at the complex, and then we have a very smooth building that is very easy to manage. And so we're going to be putting together some case studies here in the coming months, and we'll be putting them out on a quarterly basis. So watch out for that. We will have that available on the website. If you want to get on a pre-waiting list for these case studies, that way, as soon as they come out, I'll email them directly to you. Just hit me up on Facebook, YouTube, and we'll go ahead and make sure to put you on a waiting list and send you case studies when we have them.
Yeah, and speaking of case studies, I actually, one of the people I was going to try to bring on the show is an actual client where we took 3 of her single-family rentals and sold them and exchanged them into a multi-unit. The multi-unit's not yet done. It's actually in contract as we speak, and I don't want to talk about it because I might jinx the deal.
Yeah, and we've helped out so many people, and even doing this show, it's still, if you're on audio, it's very hard sometimes to visualize these numbers, and you just hear a lot of numbers coming out, right? It's much easier on the video format, but even then, it's still very hard to see some of the graphs and some of the spreadsheets that we put together.
Well, that's because we only have 10 minutes to talk about it, and it's hard to talk that.
So it's Sam's fault for coming up with a 10-minute.
It's Sam's fault, yeah, that little bell timer, and then we have little electric buzzers every time we, get beyond.
Well, that's when you're talking too much.
Well, that's just because I talk too much, and I need the electric shock to stop me.
There we go. So with that said, we'll have some actual case studies coming out soon. And thank you again for watching Keeping It Realty. It's been fun doing the show, and catch us on the next episode.
Catch you next week.